Hi everybody, it's Brett here from Metropole. Well, as a property investor, have you considered who may be the driver of a property bust or a property boom? Have you considered why this may be important for you to understand? For starters, you do not want to buy something that is going to lose significant value. So it may be beneficial for you to understand the drivers at play to lower the risks for your next investment. Conversely, it would also be beneficial to understand the drivers of a property boom, a location that you can allocate your resources that will outperform the averages and create wealth-producing rates of return over the long run. There are two different types of drivers in our property markets, home buyers and investors. So here is my thoughts on how you can capitalise. First of all, let's have a look at property booms. Who creates the booms? Well, I believe it's actually the home buyers that create the booms. Why? Well, one of my favourite sayings is home buyers buy with their hearts while investors buy with their calculator. And what I often see at ground level is home buyers who pay way too much for a property. They get carried away. They've been searching for a number of months. There's competition with other buyers. It's close to their favourite coffee shop or restaurant, or maybe they want to get into a certain school catchment or have a train line or something that's close to work, and they're willing to pay $50,000 or $100,000 more just to secure the property. And that can continually happen as people continue to miss out. So people are paying emotionally inflated prices. So it's the home buyers that drive that, because the investors, their calculator would never allow them to pay as much as that. They'd never allow them to overpay. Sure, there's a little bit of movement there with the facts and figures, but overall they're not going to get emotionally carried away with the purchase price. So it's going to be the home buyers that drive that. Conversely, the bust, well, this is where the investors come into play. Generally speaking, most investors are very short-term focused. You can think of the stock market, you can think of people trying to get into the hot spots and trying to make a quick dollar and things like that. So in the event that there is a market downturn and the market starts to drop quite significantly, investors are pulling their money out. And that's what leads to a downward spiral. And over the recent years, the mining towns and those types of examples are really good points to make, because they're the ones that investors have pulled their money out and the market's crashed 20 or 30%, maybe even in some cases more. Whereas investors do that, home buyers tend to hold their properties through downturns. They'll do anything to keep a roof over their family's head. They'll eat Maggi noodles. They might sell a car or some shares to make sure they can get through that period. They're very resilient, and Australians never want to lose that dream home, so they'll do whatever they can. And as a result, there's a bit of a floor under how much they can actually lose. So there's greater protection there. So two ways I believe you can capitalise. Firstly, very obviously, it's better to buy in an area that's heavily populated with owner-occupiers, because the booms are going to be higher and the busts are probably going to be less because there's a floor under that. So a great tool we use is domain suburb profiles to have a look at the makeup of the demographic versus owner-occupiers versus investors in certain suburbs. The other thing that may not be as evident is try and buy in areas where people's wages are growing above average. And I've talked about this on a number of occasions before. When people have higher rates of incomes and higher rates of savings, not only can they pay more for property and continue to pay more and overcapitalise, but they've also got higher savings rates and financial buffers to get through the more difficult times. So there's two really important things you should really look at considering when you're looking to invest. Yes, you want to get those above average returns, but it's also important to have that level of low risk and safety so that you can maximise your returns over the longer term. Thanks for watching.